The first thing we'll look at is our cash received from customers. So when we look at cash received from customers, we're looking at our change in the accounts receivable account. If accounts receivable increased, then we're going to deduct that increase from net sales, and if it decreased, we're going to add that to net sales. So the first thing in our statement of cash flows operating section is cash received from customers. So we take the amount for sales off of the income statement, which is $900,000, and we deduct that increase in accounts receivable of $30,000, giving us cash received from customers of $870,000. So we can see in this picture here, we have our cash received from customers. We start with net sales. We add a decrease in accounts receivable or subtract the increase in accounts receivable. Then we're going to look at our interest and dividends received. So we have dividend revenue. We have $3,000 on our income statement that shows that we received cash as dividends of $3,000. Then we also have interest revenue. So we're going to look at, we have interest received and interest and dividend received. So when we look at our interest revenue, we have interest revenue on our income statement, and we have a decrease in the accrued interest receivable account of $1,000 that we're going to add. So we add decreases of current asset accounts. So we have cash received from interest and dividends. So we have $6,000 in interest revenue, $3,000 in dividend revenue, and a $1,000 decrease in accrued interest receivable. So if we add $6,000 plus $1,000 plus $3,000, we get $10,000 in cash received from interest and dividends. So interest revenue plus a decrease in interest receivable or less an increase in interest receivable. Then we need to know how much we paid to our suppliers and employees. So when we're looking at our suppliers, we're going to look at our inventory accounts, cost of goods sold, accounts payable. So we need our cash payments, we're going to calculate our cash payments for merchandise. So what we do is we start with our cost of goods sold. And we take that amount of $500,000 off of the income statement. Then we're going to add an increase in our inventory account. So we had that inventory increase of $10,000. Then we're going to subtract an increase in accounts payable. And that increase is $15,000. So if we take $500,000 and add the increase in inventory of $10,000 and subtract the increase in accounts payable of $15,000, we end up with cash payments for merchandise of $495,000. So we take our cost of goods sold, and then we add or subtract our change in inventory and add or subtract our change in accounts payable. When you're working on your homework, keep these slides available as a good reference for when to add or subtract changes in your accounts to make calculations for your statement of incomes, statement of cash flows. Then we're going to look at cash payments for expenses. So we have non-cash expenses such as depreciation expense, amortization, any unfunded portion of post-retirement benefits, or an amortization of a bond discount. And then we also have cash expenses such as any accrued liabilities that we have if we have salaries payable or changes like that. So when we're looking at our cash payments for expenses, we're going to look at, we'll start with our operating expenses that we take off of our income statement. So our operating expenses are $300,000. Then we need to get rid of that depreciation expense of $40,000. We're going to add changes. So we have an increase in short-term payments, or our prepaids, of $3,000. And we have a decrease in accrued liabilities of $6,000. So we take our operating expenses, subtract depreciation expense, add our increase in prepaids and our decrease in accrued liabilities, we get cash payments for operating expenses of $269,000. So this is where we're looking at those timing differences between the recognition of our expenses and the actual cash payments. So this is where our accrual accounting comes in. So we might have cash payments in a different period. So you remember, like when we make an adjusting entry for our salaries expense, because we're going to pay it in the next month. So then we would have salaries payable. That's our accrued liabilities account. So when we look at changes in accrued liabilities, those are things such as salaries payable, income taxes payable. So these are expenses that are going to be paid in a different time period. So then we look at our prepaids. That's our prepaid insurance or our prepaid rent. So when cash is paid out at the beginning of the year for something that's going to benefit for us for a long time. So we're going back to Chapter 3 now, where we learn about these different prepaids and accrual accounts. So cash payments for expenses, we already kind of walked through this. So we start with the expenses from the income statement. Take your operating expenses from the income statement. You're going to subtract depreciation and any other non-cash expenses, such as amortization. And then we're going to add or subtract our changes in our prepaid accounts, and then add or subtract our changes in any accrued liabilities account. might not just say accrued liabilities. It might say salaries payable. That's an accrued liability. So here we have our cash payments for supplies and merchandise, or for merchandise, which we already calculated, and then cash payments for expenses, which we also calculated. We can add those together to be cash payments to suppliers and employees on our statement of cash flows. The next cash payments we're going to look at are cash payouts for interest and taxes. So this is our interest expense and our income tax expense. We're going to look at the expenses on the income statement, and then we're going to look at any changes in our liabilities account. So if we look at this, first we'll look at our cash payments for interest and expense and taxes. So if we look at our income statement, back to the slide that has the income statement and the balance sheet, we see that we have interest expenses of $35,000. We also have an increase in interest payable of $7,000. We're going to subtract that increase from our interest expense. So we have $35,000 less an increase in the related liability, which is the interest payable. And that says that we paid out $28,000 in interest and cash. We're also going to look at our income tax expense. We have $36,000 in income tax expense. We also have a $2,000 decrease in income tax. So if we look at that interest expense from the income statement, $35,000 less increase in interest payable of $7,000. So our interest paid is $28,000. Our income tax expense is $36,000. We're going to add a decrease in taxes payable account of $2,000, giving us taxes paid of $38,000. We add the $28,000 and $38,000 together to get $66,000. Then if we look at this next slide, we have the section of cash flows from operating activities. Cash received from customers, $870,000, interest and dividends received, $10,000, and then our payments out. That gives us, if we put that then into our table, we have that we received $880,000 in cash. We dispersed $830,000 in cash, giving us net cash flows from operating activities of $50,000.